Joining us on the show is Rakesh Sharma, ED at Bajaj Auto. Rakesh, good morning and welcome to the show, and always a pleasure to speak to you.
Good morning, Hiral.
Ra
Nice to be here.
Always a pleasure. Rakesh, clearly, the outlook with regards to the domestic business, including EVs, is absolutely positive. How are you pegging the exports from a recovery perspective? Do you think it could be at the same pace, or do you think it'll be gradual?
Hiral, the recovery in exports, as you can see, quarter on quarter, this time was, just at 2%. We've been saying that we are trying to get each quarter to be better than the previous one. We are now at about 70% of our peak performance, which was 2 years ago in FY22. The biggest drag over there is still that Africa is only at 50% of its peak performance, and South Asia is only at 60% of its peak performance. But on the other hand, Latin America is at 110% of its peak performance, and Southeast Asia is at also almost at its peak performance. However, the weight of Latin America and Southeast Asia is still, 35%. 65% of the weight is between South Asia and Africa. So when you put it, you combine it, the recovery is still at about 70%. But having said that, on exports revenue front, there is actually a 10% growth due to the two effects. One is, of course, the gentle devaluation in the Indian rupee. And the second thing is that our mix, thanks to the rise and success in Latin America, our mix in exports is also very improved. Pulsars are now 28% of our portfolio. And therefore, the EBITDA has grown faster than the top line in exports. So while volumes is down by 8%, revenue is up by 10%, and EBITDA in the business is up by a little more than that.
Right. So when you mention about the margin side of it, specifically the share of the high margin segment, taking exports and the three-wheelers into consideration, on a sequential basis, there has been some bit of pressure, not on a year-on-year basis. One, is it because the competitive intensity in the overall motorcycle space is high? And secondly, with regards to exports, there is still some more time, in terms of revival. Are these two the major reasons, or do you think this is just a one-off?
No, I am perhaps not seeing the numbers in the same way that you all are, because actually the whole improvement in the margin architecture of Bajaj Auto over the last 2 years, sequentially also, has been achieved through improvement of mix, of the business unit mix, in the sense that the rise of three-wheelers now at 40,000, and the improvement of mix within the domestic motorcycle business. Now, from a situation where we were selling 50% of our sales was only the Pulsars and above, now 70% of our business is Pulsars and above. So actually, when we look at the top half of the industry, which you can say is premium in a way, our performance, both in terms of margin and volumes over there, is the single most important factor in swinging the bottom line performance of the motorcycles business unit over the last 2 years, and also quarter on quarter.
Right. Now, in terms of the 100 to 110 cc versus the 125 cc segment, how are you looking at both of this? Is it where, you're seeing a shift happen with regards to consumers from 100, 110 cc to 125? And is that the focus for Bajaj Auto as well? Or will the focus be in the entry level, where you will continue to introduce further products?
The shift is occurring, but albeit at a gradual pace, because these are very significant architectures in the industry, and they shift over a period of time. But definitely, we are seeing over 2 3 years a 2 3 percentage point shift in favor of the 125cc plus segment. Within the 100cc segment also, you will see that the bottom one has weakened, the bottom half of that 100cc has weakened, the top half has improved. But having said that, this is only in terms of volumes. If you try to map the industry actually in terms of the profit pool, you will see that it is not 50%. The bottom half is probably a bottom third, and therefore it is a little bit of a red ocean compared to the blue ocean at the top. And our approach has been to priority number one has been to succeed very significantly in the top half of the industry, and all our innovation, etc., is majorly focused in that segment, and that's what the results we are seeing. Our next priority is to try and expand this segment and try and upgrade customers customers to the top half, because we feel that putting out a me too product and waging a war on the basis of purely price is will get us some volume, but I don't think it will do much for our profitability, and in a very minuscule manner, it will impact our profits.
So,
So therefore, the approach is to invade the bottom half from the adjacent segment of 125cc, rather than jump into it and try to do something which is not, which is sort of dilutive of our overall financial performance.
so will it be at the same price point, and will this also mean more upgrades with regards to the Pulsar series at a breathtaking speed?
Yes, the whole approach is that to widen the Pulsar portfolio. We are obviously, the innovation pipeline has got a few new products in this space, which I hope will not just attract customers sideways, that is inside the segment, but will also attract the customers up into these new products. You will see that in the next fiscal, we will be introducing products through which we will attract both the 125cc and the 100cc customer.
Right. Overall, Rakesh, with regards to where the replacement demand wave is concerned, how are you looking at it? Because if you talk about the two-wheeler industry in India, between FY 2014 to 24, the CAGR growth has just been around, say, 2%. Now, that is something which will tell you that, yes, the industry is looking at replacements. Is that something which will be one of the tailwinds for a company like yours?
I think that there is a reason to be cautiously optimistic about the two-wheeler industry going forward. I know that we have not yet, as an industry, reached the peak which had been attained actually in FY 18-19. We are still below that, but that is one of the reasons for optimism, because that watermark has been reached. The demographics of the country, meaning the youthful population, the road structure which has come in, which makes intercity, intertown, inter-village travel feasible, and the penetration of retail financing, which is now standing at about 70-75%, it will probably go up to 85%. All these things are very strong drivers. But you know, the two-wheeler segment, particularly the mass market two-wheeler segment, is a bellwether also of the state of economy in that space. And the COVID and the initial economic recovery had not reached the pockets of the customers in that space. It is beginning to do now. So we have to always take some of these fundamental drivers which I talked about. They are bolted on the macroeconomic performance of the country, and it is very, very sensitive. The segment is very sensitive to the overall economic performance in the country. And as that improves, we start to see growth rates immediately perk up, because there is space still for two-wheelers to expand in the country. And
Right.
that is the reason why we are seeing that, you know, even after a good season, sales didn't fall off in December, and that is contributing to a positive outlook of almost 8 to 10% growth in the coming. We'll see what happens, but most of the people are expecting the growth to be in 8 to 10%, which is quite solid for this size of industry.
Right. Rakesh, I'll quickly pack in two questions. How is the early read across with the white space opportunity that you have with regards to Triumph, EV, two-wheeler and three-wheeler? Because I think the EV market share has already gone to 14% versus a 10% in the two-wheeler space for you. So how is the early read looking like? What are we planning to do with regards to production? And any concerns with the Red Sea issue?
Yeah, so our objective in EV two wheelers, once we had our supply chain sorted out, both in terms of its cost and availability, has been to expand the network. And now we have started to expand our portfolio as well. And our objective is to, go out there and sell more and more. I had said at the beginning of the quarter that we'll breach the 10,000 mark in quarter three, which has happened. We are now taking aim at breaching the 15,000 mark. Of course, all these things are dependent on competitive action, as you know, but that is our aspiration. And capacities have been lined up in that to deliver that kind of outcome. And then, of course, we will set sights on quarter four. There is a discontinuity in the middle, which is all centered around FAME and how competition in the industry responds to any change in FAME. And then we will set our aspirations for quarter four. But we are not disadvantaged now in terms of capacity. That is not a constraint. Similarly, in Triumph, uh, we have entered a new segment. And it is we are taking a long term view of this, because the customer over here is sensitive. We need to deliver a very fine customer experience, not just of riding the product, but owning the product, etc. We have to put in those kind of capabilities. We have opened up 50 plus showrooms in the last few months in 42 cities. We are going to take this to about 100. And more than just opening the showrooms, it is about delivery of the customer experience and bringing the Triumph brand to life. You know, what entering the Triumph world really means. Putting this capability, the nuts and bolts of it, takes time, and we are not shortchanging it. We are aware of it, that we have to perk up this capability. So it's a step by step. What gives us encouragement is that in those markets where we've been there for 3-4 months, good markets like Bangalore, Cochin, Trivandrum, which are the heartland of the 250 to 500cc classic bikes, we are achieving market shares of 15 to 20% in specifically those cities. So that's a very encouraging thing, which emboldens us to continue to invest in this capability building. Capacities are also being put in place. Right now, we are looking at 10,000, which will service both exports and domestic. And then we will be increasing it further in quarter one or so. In terms of the Red Sea point, the question which you asked, it has three kinds of impact. One is that, of course, container availability. When this whole cycle of container movement gets interrupted, what happens is the container locations become imbalanced. So container availability and shipping opportunities have impacted the schedules to some extent in December and January. The second thing is that, of course, it starts taking more time because alternate routes via the Cape of Good Hope have to be planned, which add 2-3 weeks more to shipments in Africa and Latin America. Therefore, our partners have to invest a little bit more because more stock is on the water. So those supply schedules are also being relooked at. And finally, the third impact is in terms of cost. Freight rates have doubled. What was $3,000 is almost $6,000 per container. And that again has to translate into pricing. Hopefully, if the conflagration doesn't widen, we should be able to see through this interruption, which I think is probably temporary. I'm hoping.